Good morning, guys. Welcome to TalentBlazer, India's latest edtech platform that is there to help you at every stage of your career. Now, I'm your teacher and friend in this journey, and I am covering UGC NET Paper 2 Commerce. The subject code for the same is 08. And I've already made two videos on Unit 7, that is Banking and Financial Institutions. And this is the third video. And I hope you must have answered all the queries in the last unit that I did ask you in the video. So I did ask you a few questions, and those are pretty much relevant for your examination. So if you're following the videos and if you're doing your preparation right, you must be able to answer those questions, right? So in today's class, we'll cover something new. And before I start with today's class, I just want to talk about TalentBlazer a bit. TalentBlazer has come up with this, a motive to provide good education at affordable rates, and that is why we are covering UGC NET Commerce and other subjects as well. And there is a TalentBlazer app that you can download from the Play Store, and that app is very helpful because there are mock tests available, and that is very much needed in your examination preparation. Be it any examination, you need to practice mock tests. Only then you can succeed with those examinations, right? So in today's class, we'll start with types of financial market. I have already discussed about what is financial market. I have discussed about this in the video of financial segment. So if you haven't watched the video, please go and give it a watch and then continue this one. So in this, we'll discuss with types of types of financial market. And the first type of financial market is money market. So money market means market where money or its equivalent can be traded. So equivalent can be, the example for equivalent can be treasury bills and certificate of deposit, or you can take example of your saving account as well, right? So money is synonym of liquidity, right? Because if I have to go to a store and I have to buy something, I will give that store owner a cash in something of if in something of product that I want to buy, right? So money can be used because it's so liquid. I can use it anywhere, right? So there are some assets which are money like, which can be tradable easily. They're highly liquidable as well. So those are traded in money market. We'll discuss about all of them in today's class, right? So money market consists of financial institution and dealers in money or credit who wish to generate liquidity. As I said, we are talking about the liquidity here, and liquidity is very important while we are talking about money market, because high liquidity denotes that we're talking about something which is near value to the money, right? To the cash money. It is a better known as a place where large institutions and government manage their short-term cash needs. So in money market, who actually participates? These are the participants, large institutions and government, because they have to manage their short-term cash needs. So I will tell you the concept with the help of an example. Let's suppose I'm a big company, and somebody have bought the goods from me on credit, and they will pay me after a while, right? That's how it goes. Now, after a month, they will pay me the amount. Now, within the month, because I have to run my business expenses, that is working capital, and I don't have that, right? For a month, I don't have the money, and after a month, I will get my payment. So for that month, I have to pay the salary to my workers, electricity bill, water bill, and so many things, right? Rental expenses. So for that short period, I need some money, urgent money, and then I'll go to the money market to raise the fund for a while. And a brief, if you want to differentiate between money market and capital market, if you want to differentiate between them, you should remember that while we are talking about the money market instrument, the maturity period of all those instruments we are dealing with in money market is less than 1 year. If we are talking about the instruments whose maturity is more than 1 year, then we are talking about capital market specifically, right? So what are the benefits? What are the benefits of money market? So it exists to facilitate the transfer of short-term funds between holders and borrower of cash assets. Let's suppose I am running a company and I need money, right? So there is a transfer of money from someone who has hold the money, a lot of money with him, and certainly they don't want to use it for this. Certainly they don't have any need for that money. So what will they do? They will lend it to someone like me, someone who is in need of money, and they will get some interest over it. They will earn some interest over that money, right? For the lender, and investor, it provides a good return on their funds. As I told you with the help of an example, that investor or the lender will earn the interest over the money that they lend. Right. For the borrower, in this example, me, right, it enables rapid and relatively inexpensive acquisition of cash because I need that cash. I need to run my company. I need to manage my company. I need that money. Right. For the borrowers, it enables rapid and relatively inexpensive acquisition of cash to cover short-term liabilities. Right. Do focus upon that while we're talking about money market, less than 1 year of maturity period for all the financial instruments. And we have to cover short-term liabilities. I will be needing that money to cover short-term liabilities, not long-term liabilities. For that, if I want to raise that money, I will go to the capital market, right? Now we'll talk about the most important part for your examination, the money market instrument. Right. So first, money market instrument. I think you must have started this in your 12th and in your undergrad and somewhat in your post graduation if you have taken any finance related subject. Right. The first money market instrument is treasury bills. Treasury bills, one of the safest money market instrument. And if I have to define money market instrument, they are very safe and very secure, and the risk associated with it's pretty less. So the returns aren't that high. If we want to talk about the returns are not that high while we are talking about money market instrument. Right. Treasury bills, one of the safest money market instrument, are short-term borrowing instrument of the central government of the country issued through the central bank, that is RBI in India. I think everyone must be knowing that in our country, RBI is a central bank, right? And RBI full form is Reserve Bank of India. So if let's suppose we are talking about the government need to raise money for a while. So what will they do? They'll ask RBI to raise funds through treasury bills or some other instruments, right? Because government won't participate directly, they'll ask RBI to do it. So they are zero risk instrument, and that's right there a question for you guys because sometimes they will ask you which of this instrument is a zero risk instrument, right? So there will be four options. You have to mark the right one. Treasury bill is a zero risk instrument, and hence the returns are not so attractive. While we're talking about this risk and reward ratio, it's pretty important when we're talking about something where high risk is involved. We are bound to get high returns in that place because why will you place in such a risky venture when there is no high return from it, the return that you can earn from it, right? So these are the zero risk instrument, hence the returns are not so attractive. It is available both in primary as well as secondary market. So we'll discuss about the primary and secondary market in few minutes, so do not worry about that. It is a promise to pay a set sum after a specified period. T-bills are short-term securities that mature in 1 year or less from their issue date. So these securities get mature less than 1 year. That's what I have been telling you for a while. They are issued with 3 month, 6 month, and 1 year maturity period. So if categorization we have to do 3 months, 6 months, and 1 year maturity period. The central government issue T-bills at a price less than their face value, that is par value, right? So let's suppose I can discuss this with the help of an example. So central government want to raise some money. Let's take the example of 1 lakh rupees, right? So they'll want to raise 1 lakh rupees, so they will float T-bill in the market. Now, while they are floating that Oh, okay, so just a change. Central bank want to raise some money, and that money is rupees 90,000. So what they will do, they will issue a T-bill of 1 lakh rupees in the market at a discounted price of 90,000. So what will happen here? Let's suppose I am one of those, who wants to buy the treasury bill. I am one of those investors. So what will I do? I will buy the treasury bill, and I will pay the government 90,000 rupees as of now. Now, after the maturity period, let's suppose we're talking about 91 days, so T-bill. So after 91 days, government will pay me 1 lakh rupees, right? Because those T-bills were issued at a discounted value of 90,000. I bought them from 90,000. And why? And when I'm selling it for rupees 1 lakh, and I'm getting 1 lakh rupees. So 10,000 is the amount earned by me, right? So central government issues T-bill at a price less than then their face value. Face value is also called par value, that is discounted value. In our example, 90,000. They have issued at 90,000, and I have bought them at 90,000. So after the maturity period, when I have to sell them, the government will repay me. Will pay me, not repay me. Will pay me 1 lakh rupees, right? So at present, the government of India issued three types of treasury bills through auctions, namely 91 day, 182 day, and 364 day. Now, the one of most important points, which are actually skipped by a lot of people out there, and they don't discuss this one. There are no treasury bills issued by state governments. Only central government issues treasury bills. So I hope everyone who is following or who is watching the video is crystal clear with the concept of treasury bills. And I hope you do remember this, that no state government can, issue or raise funds through T-bills, right? So this is one of the most important money market instrument, and you are expected to get a question, from money market instrument, right? So T-bills, zero risk instrument, and 91, 182, 364 days, and no treasury bills issued by state governments. Now the next one, repurchase agreement. So repurchase transaction called repo or reverse repo, right? So this is a very important concept, repurchase agreement as well. Now it is in the news as well, because RBI has increased repo rate and reverse repo rate. So I'll talk about repurchase agreement first. So what happens basically? Yeah, let's suppose I'm getting into contract with someone, right? I have the securities with me, and I have, let's suppose I have XYZ securities with me, and I want to indulge into a contract with you guys, right? So I have picked one person, and I want to get into a contract with one person. Now what happens is this: I have the securities and I need money, so that person will give me the money. I will give the securities with a promise that in future I will repay the amount and you will give me the securities back at a different date, at a predetermined rate, at a predetermined price, at a predetermined date. So we'll discuss about that, at what date you will give me my securities back and I will pay you the amount, right? So that is called repo transaction, if we are talking from the seller point of view, right? So repurchase transaction called repo or reverse repo are transaction or short term loans in which two parties agrees to sell and repurchase the same securities, right? So please do emphasize on this one, that two parties agree to sell and repurchase the same security. So as I told you, with the help of an example, let's suppose I have XYZ securities with me, and I'm indulging into a transaction with X student, or let's suppose A student, right? So and that A student has the money, I have the securities, I am selling my securities, A student is giving me the money, right? But I am telling the A student that in future I will buy the securities, these securities from you, and I will repay the amount with some added interest at whatever price that we have discussed and defined, right? So this is repo transaction. So repo transaction can only be done between the parties approved by RBI and in RBI approved securities. So you and I cannot indulge into all of these repo transactions. Only the parties approved by RBI, they can indulge into these transactions, right? Under repurchase agreement, the seller sells specified securities with an agreement to repurchase the same at a mutually decided future date and price. So, right. So this is repurchase agreement where the seller sells specified securities with an agreement to repurchase. So I will buy those securities that I'm selling to a student. I will buy those securities from a student in future, right? So under repurchase agreement, the seller sells specified securities with an agreement to repurchase the same at a mutually decided future date and price. Similarly, the buyer purchases the securities with an agreement to resell the same to the seller on an agreed date at a predetermined price. Such transaction is called repo when viewed from the perspective of seller of the security, and reverse repo when viewed from the perspective of the buyers of the security. So repo transaction, it will be called repo transaction when I have XYZ securities and I am selling it to A student, right? The A student, that then it will be called as repo transaction. And if A student comes and says, sir, I want to buy these securities, right? Sell me these securities at this price, and you can buy them after a while. So I'll say okay. So if we are thinking about, if we are talking about from the perspective of a student, then we are talking about the reverse repo transaction. So this is repurchase agreement, one of the most important money market instrument, and you can definitely expect to get a question from this because this concept is being used in your economics as well, and RBI. This has been in the news for a while, recently trending. So this is the definition. This is the meaning. I hope you are clear with this now. And I ask, like, for all the students who are watching this video, please go through the you know the news as well, because this is very important for you guys.